Hi, this is Miranda from Finance Talking, and today we're going to be talking about Ebitda. That's Ebitda. So, what is Ebitda and what's it used for? Well, first of all, it stands for earnings, that's profit, before interest and tax, and also before depreciation and amortization. So, Ebitda is just a form of profit, and it's similar to operating profit or EBIT, earnings before interest and tax. Now, the first thing we need to understand to get to grips with EBITDA are depreciation and amortization. So these two, depreciation and amortization, are deductions from profits, and they reflect the wearing out or using up in value of a company's assets. Assets that you can touch, that's tangible assets, are said to depreciate, whereas intangible assets, that those you can't touch, like licenses or patents, are said to amortize. So, for example, if you bought a piece of equipment for 5,000, which you thought was going to last for 5 years and have no residual value at the end, then you'd be likely to depreciate it by £1,000 a year. Similarly, if you bought a 10-year license for 5,000, you'd amortise it over 10 years, reducing the value each year by 500 until it was worth nothing. These amounts, these depreciation and amortization amounts, reduce the value of the asset in the balance sheet and reduce profit each year. Now, what makes these different from other expenses is that they're not cash costs. Of course, you spend the money when you buy the asset, not when you're depreciating it. So when we're looking at EBITDA, we're looking at the profit excluding these non-cash costs. So to understand a bit more, let's look at a simple income statement. This company sells £100,000 worth of goods or services, and the goods cost the company £50,000, which leaves £50,000 of gross profit. Then it incurs general and admin expenses, or other operating costs, of £30,000, leaving an operating profit of £20,000. Now, operating profit, or earnings before interest and tax, is the profit from the company's operations. It's the profit for which operational management can be held responsible. The things that come below that are interest and tax. And interest is a function of how the company is funded, so it's the responsibility of Treasury or finance. And tax is largely a function of government policy, so it's beyond the control of operational management. Now, you could also argue that depreciation and amortization are outside the control of operational management. The D&A policies are usually set by finance rather than operational management. So for that reason, EBITDA is a useful level of profit to use in financial management. So now let's see how we can find the EBITDA. Now, in our income statement, like most you'll see, depreciation and amortization are not shown separately, but they'll be included in two or more lines. In this case, there'll be some in the cost of sales, which is likely to include, for example, depreciation of plant and machinery, and there'll be some in the other operating expenses, which will include, for example, the depreciation of office equipment and so on. And these lines may also include the amortization of intangible assets such as licenses or patents. In a real set of company accounts, you'll find the total depreciation and amortization in a note somewhere. For now, let's put some numbers in. We'll assume that the depreciation and amortization included in cost of sales is £10,000, and included in other operating expenses is a further £5,000. So D&A in total of £15,000 has been deducted in arriving at the operating profit or EBIT. And remember, these are non-cash costs. Now, to find the EBITDA, which brings us closer to understanding the cash profit, we simply need to add back £15,000 to EBIT. We're adding back because we need to find the profit before deducting those expenses. So, of course, EBITDA will always be higher than EBIT. So here, the EBIT is 20,000, and then we just add the D&A of 15,000, and that gives us EBITDA of 35,000. So now we have a rough idea of how much cash profit the company's generating. Of course, this is still not truly a cash flow number, because apart from anything else, the revenue is likely to include amounts that haven't yet been received, so receivables. And the expenses are likely to include amounts that haven't yet been paid, so payables. But we're closer to cash flow than we would have been if we'd just used EBIT. So let's just summarise who uses Ebitda and what for. Well, Ebitda is a rough approximation of cash profit. It's often used internally as a financial management tool as it represents the profit controllable by operational management. Externally, it's used as a rough measure of cash flow, and also it strips out the impact of different depreciation and amortization policies from company to company if you're trying to draw comparisons across a sector. And finally, being EBITDA positive, so making a profit before D&A, is often used as an early milestone for companies starting out, meaning that they're part way towards being truly profitable at the operating level. So that's EBITDA. Come back soon for more.